Welcome to this video on self-assessment for individuals. In later sessions, when we start to look at income tax, you'll see that some forms of income are subject to tax at source, such as the tax an employer deducts from wages under the pay-as-you-earn system, but others are not, such as property rental income. In this session, we'll look at how the self-assessment system works for individuals in terms of filing returns and the payment of any tax not paid at source. Taxpayers who are self-employed must submit tax returns, as may individuals whose taxable income is above the basic rate limit and who therefore pay tax at the higher or additional rate. Taxpayers who have untaxed income, for example rent, also have to file tax returns. Finally, any taxpayer who has made a chargeable capital gain in the year also has a duty to submit a tax return. A self-assessment tax return for a particular tax year, which includes details of both income and capital gains arising in that year, must be filed before the 31st of October following the tax year, if it's submitted as a paper return, or before the 31st of January following the tax year, if it is submitted electronically. Key point here is that if a return is not submitted by the 31st of October, this does not mean it's late, merely that it must then be filed electronically. This is important to understand, as penalties will only apply to returns filed after the normal 31st of January deadline. There are situations where the taxpayer has a different filing date, mainly where a notice to file is issued to them late. The online return can be filed within 3 months of the date of issue of the return or notice if this is later than the following 31st of January. Late filing of a return will initially result in a £100 late filing penalty. Additional daily penalties of £10 per day may be levied in respect of returns which are more than 3 months late. The daily penalty can be imposed for a maximum of 90 days. If a return is more than 6 months late, there will be an additional penalty of 5% of any liability to tax which would have been shown in the return, or £300 if that's greater. And again, a further 5% or £300 if greater when the return becomes 12 months late. Let's look at an example. Harriet filed her tax return online on the 1st of August showing income tax payable for the year of £12,000. The return should have been filed on the 31st of January, so is 6 months late. As the return remained unfiled at the 30th of April, 3 months later, the daily penalties become due. In fact, since the return still remains unfiled 6 months after the 31st of January, a maximum of 90 days of these £10 penalties would be charged, totalling £900. At the 31st of July, another penalty will be charged, based on 5% of the tax liability for the year, or £300 if that's greater. 5% of £12,000 is £600. The total penalties for late filing would be £1,600, being £100 plus £900 plus £600. After the end of the tax year, an income tax calculation can be put together for an individual, which we'll discuss in detail across a number of sessions, to bring all of their types of income together and calculate the total income tax liability on that total income. Any income tax remaining payable after deducting income tax already paid at source is payable under the self-assessment system. The general rule is that income tax payable is due on the 31st of January following the end of the tax year, but this isn't the full story. Some taxpayers may also fall within a payment on account system, whereby some tax may already have been paid on account of tax due for the year. This payment on account system is relatively complex and there are a number of variations to the general rules which we need to look at. These payments on account are due twice. The first is paid on the 31st of January falling within the tax year in question, and the second on the 31st of July after. The problem is that on the 31st of January falling within the tax year, we haven't yet reached the end of the tax year, so we can't possibly know what the income tax payable under self-assessment will be. So the payment on account system says that we'll take the amount payable for the previous tax year and set the payments on account as 50% of this. This is the maximum that the taxpayer will have to pay as a payment on account. But if there is reason to believe the tax payable for the year will be less, the taxpayer can ask to reduce the payments on account to 50% of what they expect to be payable for the year. So let's think about an example. Scott had income tax payable for the previous tax year of £2,000, so will be asked to make payments of an account of £1,000 each towards the current tax year on the 31st of January that falls in the current tax year and the 31st of July after the end of the current tax year. If Scott knows that his current year income is lower and therefore the amount payable will be just £1,600, he could make a claim to reduce his payments on account to £800 each, being 50% of the amount he believes will be payable for the current year. Throughout, I've been referring to the amount, as in fact it's not just income tax which is paid in this way. Class 4 national insurance, which we'll discuss in detail in a later session, is paid along with income tax. So the payments on account are based on the amount of income tax and Class 4 national insurance due. Let's start looking at some variations. First of all, the situation where tax is payable under self-assessment is less than £1,000. Where the tax payable for the year is below £1,000, HMRC will not require payments on account to be made for the following year. Instead, the tax will be payable in full as a balancing payment on the 31st of January following the tax year. Secondly, tax payable under self-assessment being less than 20% of the total tax liability for the year. This really applies most often where the taxpayer is perhaps employed but happens to have a small amount of tax payable under self-assessment. This could be because they run a small business in their spare time or have some rental income, or maybe just that they have some higher rate tax to pay on investment income. So where the amount remaining payable under self-assessment is less than 20% of the total tax due for the year, again no payments on account will be necessary for the following year, leaving all of the tax to be paid as a balancing payment on the 31st of January following the tax year. Let's see how this works in practice. Mark has a total tax liability for the current tax year of £10,000. He's suffered pay-as-you-earn deductions on his employment income of £8,200, leaving £1,800 to pay under self-assessment. He had not made any payments on account for the year. In this case, 82% of Mark's total tax has been paid at source, leaving just 18% to pay under self-assessment. The total to pay on the 31st of January due date will be £1,800 for the current tax year, with no payments on account due for the following tax year. So on the 31st of January each year, taxpayers will make a balancing payment of tax for the previous year. So far, we've been talking about this in terms of income tax and Class 4 national insurance. But just to complete the story, any capital gains tax due for the year would also be payable on the 31st of January, as would any liabilities to Class 2 national insurance. These are always paid in full as part of the balancing payment and have no effect on payments on account for the following year. Late payment of tax of any type will incur interest charges as detailed in your tax tables and discussed in the video on tax administration, penalties and interest. The relevant rates as given in your rate sheet are 2.6% for late payment interest and 0.5% for late repayment interest. In addition to this, penalties may be applicable. These are generally referred to as surcharges and only apply to balancing payments of tax, not to payments on account. The first surcharge applies where the balancing payment is 30 days late and charged at 5% of the unpaid tax. A second surcharge applies where the balancing payment is 6 months later and charged again at 5% of the unpaid tax. A third and final surcharge applies where the balancing payment remains unpaid 12 months after the due date, again at 5% of the unpaid tax.